Hi everyone and welcome to sample problems for chapter 1 and 2. So let's start with it. So we are going to solve two problems. So problem number 1, what's happening? So Knights is a company with investment opportunity that will be worth either 100,000 or 400,000 in 1 year, and they have given probabilities assigned to that. So there is 30% probability you get 100,000, there is 70% probability you get 400,000. The investment will require $150,000 of financing. The company can do maximum financing with 25% debt at the rate of 6%. The tax rate of 35% is given. The expected after tax return on equity is 9%. So what's happening? This is the business potential, 100,000 or 400,000. You have probabilities assigned to that. Plus, how for doing this you need $150,000 of financing. There are two options. Option 1, you go with 100% equity. They have given rate of return or expected on equity. Option 2, you go with 25% debt and rest is equity financed. So in these options, right, which option would you choose? So determine the amount by which expected return to equity increases if Avalon uses debt. So you have to determine which option is better and how much does it increase. So how to do this? So going to this Google Sheet, problem number 1, there are two potential outcomes. $100,000 with 30% probability, $400,000 with 70% probability. So 100,000 into 30%, right, is one outcome, and 400,000 into 70% is the other outcome. So probable returns, how do we calculate that? So potential outcome into probability plus potential outcome 2 into probability. That will give you probable returns that you can expect, or the average expected return from this opportunity. That is 310. How did I get it? 100,000 into 30% plus 400,000 into 70%. Now there are two options. First is you do everything at 9%. You finance this opportunity at 9%, right? So 9% is the rate of expected return for you. So what you will do, you will calculate NPV of this, present value of this, because this is going to happen at the end of the year. So you will calculate present value of this at 9%. So that is $133,000, right? How do we calculate NPV? Present value of this minus financing needed in current terms. So it is 310,000 divided by 1 plus 9%, because you're going to discount it for a year, and subtract $150,000 from it. So that gives you NAV at 9%. Same way, you will calculate NAV at 25% debt, 75% equity. So first of all, you need to know weighted average cost of capital. So how do you know how do you calculate weighted average cost of capital? So you have 25% debt and 75% equity. Cost of equity, we know it's 9%. Cost of debt is generally the given interest rate 6% into 1 minus tax, because debt payments are a tax deductible expense. So 6% into 1 minus 35%, that gives you cost of debt 3.9%. So you have cost of debt, you have cost of equity, you have percent you raise from debt, you have percent you raise from equity. So you calculate weighted average cost of capital. 25% debt into 3.9% cost of debt plus 75% equity into 9% cost of equity. So you get 6.76%. That is the weighted average cost of capital for option 2. So if you calculate NPV at 6.76%, you get a higher number. How did I do that? So it is 310,000. Now you have to discount it by 6.76%. So divided by 1 plus 6.76% minus the financing needed 150. So you get 140,000 of profit after paying for financing. So profit in option 2 is higher than option 1. And how much it is higher by? It is almost higher by $6,000. So you get $6,000 more after tax if you use some debt in your cost of capital. So this was problem number 2. Problem number 1. Problem number 2 is easy. So an investor has a $10 million portfolio in Microsoft share. The volatility of Microsoft is given 2% per day or 32% per year. So they are asking you what is a 10-day 99% value at risk. So we are going to cover value at risk more at the end of the course, but how to do such kinds of problem. So how do we do that? First of all, they're asking you 99% var, not 95%. So it is okay. So I get what I've done. So this is 95% var value, right? This is the z value for var, and this is 99% var value, z value for var. So if you are given in question 99%, you use 2.33. If you are given 95%, you use 1.65. Okay, so position size is $10 million. Volatility is 2%. How do we calculate 1 day var? So 1 day var, the definition is this is the minimum loss that will be incurred 5% of 1% of time. This should be 99%, so 1% of time. You're calculating 1% of time. So how do you do that? So it is simply $10 million, the position, into 2.33 because it's 99% var, into daily volatility 2%. So $1 million into 2.33 into daily volatility of 2%, that gives you minimum daily loss that you will face on Microsoft, that is $466,000. Now if you want to find out the minimum loss that you can face in a 10-day period if everything falls apart, so that also you can calculate. So it is 10-day period, so it is position size into volatility into 2.33 because it is 99% var that they are asking you to calculate, into square root of time. Square root of time, that is 10, so square root of 10, so that gives you $1.47 million. Okay, so that is problem number 2.